Welcome to Market Thoughts for February 22nd. I'm David Lighthouse coming at you with weekly changes, the fundamental news that caused those changes, what our analytics say happened next, and what you should think about doing in response to that. First off, weekly changes. March corn lost 4.25 cents on the week to end the week at 427.5, essentially right in the middle of this 420 to 436 trading range we've been talking about, but a continuation of the downtrend that started after failing at that 436 resistance. So buy signal here. We said 436 is the target. It was. We failed there. We've now been sliding back towards the bottom side of this range. We don't think we're going to fall much further than this, but if we do, we still expect this 420 support to hold up. If we fan over to soybeans, pretty modest outcome on the week for beans, 4.5 cent gain. This was a high leverage week, as we noted a week ago. We would have thought some more fireworks. Here's how it worked out on daily chart. 3 quiet sessions, and then Friday, more on this in a second, but a wild day on Friday in response to tariff news and trying to disseminate what that means. Prior to that tariff news, beans had chased all the way up to 1148, clear breakout higher in a continuation of this uptrend. That tariff news drop fell all the way back to 1121, back to the lowest levels since the tail end of 2 weeks ago, and then ended up paring those losses back to close down slightly on the day. So that's what beans did in response to that news. And then there's wheat. Wheat finally doing something we wanted it to. You gained 15.5 cents on the week, and more importantly, you got up to and just a little bit through this 590 target. So buy signal, one back here too, and then a sell signal, and then buy signal back here in mid-January. On this buy signal, new contract lows, we said that should be the end of the falling for wheat. The target should be this 590 resistance at a minimum. So we got here on Friday and got through it just a little bit, faded a bit into the close. So you're back to a pretty high stakes spot on wheat. We'll talk about what we think happens next now alongside this, but you did manage to make highest levels on wheat since back here in late September with the move on Friday that we've been talking about for some time. All right. 2 fundamental things happened this week, and both of them a little bit unique in the grand scheme. Ag Forum, this is not any sort of actual survey, obviously, or anything like that. This is economic statistical models saying what should we expect for corn and bean acres in the upcoming year, and then what does demand look like in response to that. These numbers, by definition, will change a lot as we go through the year, but it gives us a starting off point. 94 million acres of corn, down almost 5 million from the year prior. Using trendline yield and these demand assumptions, you end up with a 1.8 billion bushel carryout, 11.4% stocks to use. 2 things to take away from this. First, this is a significant year-over-year decline in carryout. Stocks to use at 11.4%, huge demand base. You're not that far from, alongside a weather scare, having a normal significant summer rally like we've been talking about. This is not as bearish as it would look given the massive crop this last year. Second, you still are at a level that makes it very tough for a big explosive runaway higher price. So normal 10% seasonal rally, high odds of occurring, 40, 50% type bull market transition rally, still very low odds of that occurring. So in a way that's liberating. It helps guide our decision making because we know with more certainty the range that we'll be operating in. On the same side, most of those 4.8 million acres went into soybeans as expected at an 85 million acre bean crop, trendline yield beginning stocks of 350 million bushel. That actually takes you to a carryout virtually unchanged from this year, 8% stocks to use. Interesting. Not a lot of margin for error, but not nearly as bullish as some of the scenarios contemplated if corn acres stayed higher. So if this is right, if beans have done enough to get 4 million acres to switch back into them, just given normal rotation mixes, high input costs, everything that goes with that, this sets us up to where we can make some assumptions about what should happen next price-wise in the upcoming year. We've been tracking 2017 seasonal versus 2026. It could be any seasonal, though they follow roughly the same pattern. We like the analog. These are scaled. The pricing was very different in these 2 years, but they're scaled to the same. From that September 1 price is 100%. what happened next. And you could see very similar pattern. Actually, 2017 had a bigger winter rally and secondary rally, but in both cases, well, we don't know for sure in this case, but in 2017 and in most years, you're at the end of your winter soybean seasonal. It's not common to rally beyond this level till we get into our summer rally. And in 2017, your summer rally topped out at 113% of your SEP 1 price. That would put you around 1170 November bean futures, which, if you recall from our next trade from a couple weeks ago, is our upside target for soybeans for a spring summer calendar year high. That still appears on track, and also unlikely to see a huge rally beyond that level with the news that we've gathered over the last couple days. Same exercise for corn. If we take the Ag Forum numbers, end up at this 11.4% stocks to use again. If we look at the seasonal on corn, this has been tracking pretty closely. Also, you've actually been underperforming 2017. And again, these analog years, a lot of fundamental similarities, especially on corn, 2017 versus 2026. And you've been tracking similarly. Corn's winter rally also concluded in 2017 around now. This is tough to call it a rally on new crop, but we have rallied from the buy signal after the Jan WASDE, and it looks like we're coming to the end of that. If we do the same exercise, though, you had roughly a 13% SEP 1 to June high rally. That same experience this year would put you right around $5 December corn, which has also been our upside target for new crop corn. There's a couple things to note alongside this. The last 2 years, we haven't featured any meaningful weather rally, any reason, any weather catalyst in that peak growing season window. And last year, literally none, no threatening weather the entire time. That's extremely unusual. Probability would say that we get some sort of threatening. If we don't get that weather, we won't get this. But if we do, this is where it should take us, not to 475 futures. It should be higher than that, but not to $6 futures either. That this all fits seasonally with what we should be thinking about for upside targets for spring, summer, based off these Ag Forum numbers. Then on to this. So right in the middle of my last recreation day on vacation, this news dropped. Finally, the U.S. Supreme Court ruled on Trump's tariffs and said using a federal law meant for national emergencies was not legal for the tariffs that he enacted. So immediately in the aftermath of this, if we flop over to soybeans, let's take this down to a 5-minute chart. This was that tariff news drops, and this was the aftermath of it and chasing all the way down in just a few minutes. The thinking being, obviously, most of this latest bean rally has been tied to China saying, hey, what if we bought, and I don't know if they said that, but the president saying, China said, hey, what if we bought another 8 million metric ton of soybeans? Even though currently the pink line, U.S. soybeans, are well over $1 a bushel more expensive than Brazilian soybeans. Brazil's harvesting a record crop. Chinese inventories at port are record high. What if instead of all that, we just did goodwill purchases, presumably government reserves? That's got the bean market fired up. Well, if these tariffs are deemed illegal and going away, probably don't need to do goodwill purchases of beans at $1 over the market that we don't even need for our inventory. Then, as this unfolded, somewhat predictably here, the administration said, in so many words, no problem, we'll just find another legal justification or means for these tariffs, and then announced something that amounted to another 10% tariff for everyone in the world. This situation is unfolding, but just this highlights, if nothing else, the high stakes that beans are in right now, the high leverage spot that they're in. If we just strip all, and it begats just in this twilight zone right now, is this story bullish or bearish? And ironically, tariffs getting rolled back due to the Supreme Court ruling, overall, the long run would be really bullish for U.S. ag, but in the short term, if it undoes the potential Chinese goodwill purchases, it could be a little bearish. And then alongside that, just the administration saying somewhat predictably that Supreme Court ruling or not, we're still going to do whatever we're going to do on tariffs. So stay on the edge of your seat. This is not the place you come to for cutting edge insight on what happens next on that front. We don't know any more than you do, but it is enough to note that this will be hanging over this bean market as we move forward. So what happens next? What happens next alongside this then, and what should we be thinking about doing with it? All right, let's get off of feeder cattle here and pull up corn. So corn signal is at 46, neutral, just a little bit below neutral. 29, 33, 53, 41, 59. If we look at these two gauges, range and momentum, they're very low. Extraordinarily unlikely that you're at any sort of meaningful high with a signal score of 46, range and momentum 29 and 33. Our classifier data is neutral. Recall from Friday's email, we're showing that data in there now. You were actually right on a 50% expected 20-day higher trade. So our analytics here are not giving us much to go on, and corn is trading in a really well-defined range. We would continue to say the overall numbers we talked about sets up high probability that when corn breaks out of this range, it will be up, it will be higher, and that December corn still will target something close to that $4.90 to $5 upside. July corn $4.75, somewhere in here. Until we have a sell signal or something closer to a sell signal, we can go with that thought. Other than nearby corn, other than March basis stuff that should have been priced already. Certainly, if you're listening to these comments and working with Lighthouse, it likely is or would have been. Other than that nearby stuff, this longer term, we can wait on this signal a while longer to see that alongside what our upside targets are. Soybeans are where it starts getting a little more nuanced, because soybean analytics are saying sell. You're at day 8 above the sell threshold, and look at these market gauges, some of the highest aggregate market gauge scores we've ever seen, and this seasonal change is about to start climbing too. So these analytics are saying sell. The only thing that's holding us back a little bit on the analytics front is our classifier data is still bullish. As of Friday, little over 60% of similar days to Friday experienced higher trade over the next 20 days. And the trend, of course, is still higher here too. But that sets up some pretty clear takeaways. This is still a high leverage spot on beans, and the tariff ruling from Friday indicated that even more so. Both old and new crop should be getting hedged here. Old crop aggressively, if haven't done so, and new crop relatively aggressively, but especially in the case of new crop, more in a structure, a min-max, put a floor in, still have a ceiling. Don't risk losing these prices, but still leave yourself upside. That's what these analytics are saying. And then there's wheat, where it gets progressively more tricky. So your wheat signals up to 70. That's a level that supports hedging. Futures are at 5-month highs. Futures have hit our upside target, and at least for now haven't pierced through resistance. And your market gauges are climbing. 4 of the 5 of them are above 50, and your classifier on wheat is negative. Only 24% of similar days experienced a higher 20-day price change. So these are analytics that support hedging without a doubt. The challenge, of course, is that wheat price is still mediocre. The wheat price itself is still mediocre. Wheat's rallying on geopolitical Middle East concerns. That hasn't panned out for going on 4 years now. That story hasn't been good, and you don't have a lot else to fall back on fundamentals for wheat. So as much as we hate to say it, this looks like a level to start hedging wheat again after months of inactivity, even though price, the stocks to use, is still low and our prices themselves are below break even. These analytics are saying, pay attention on wheat. We've achieved our upside target. It's time to start thinking about hedging activities of some sort.